Hey everyone, so we have reached the end of the financial year in Australia, so I thought that it would be an appropriate time to show you the performance of my portfolio over the last 12 months. And as a little bit of a teaser, I have significantly outperformed the indices in the United States and Australia. So in today's video, we're going to be going through what are the stocks in my portfolio and what percentage they make up, how much cash I have, the returns of the individual businesses in my portfolio, as well as the portfolio overall. And then we will compare my portfolio performance to the major US and Australian indices. But more importantly, I think I'm also going to be talking about why my outperformance over the past 12 months was no accident, why I was able to so significantly outperform both of the indices, and then therefore how you can do it too. Just before we get into the video, I am pleased to announce that Learn by Example is now open for July enrollment. Learn by Example is a platform and community that I run in order to help a small number of long-term investors to achieve confidence and consistency in their stock market returns by diving deeper into the analysis process. Students get access to 40 hours of stock analysis reports and 60-minute presentations, plus new ones are released every 2 weeks, which can serve as case studies for developing an understanding of stock analysis. Students also have access to a private community of like-minded investors where you can participate in weekly Q&A live streams and have access to me Monday through Saturday for all of your investing related questions. There are many online investing courses available right now that just repurpose information that you could find in a couple of $10 investing books, but they do not provide the learning environment for ongoing questions and support, which is what Learn by Example provides for its students. On top of that, students get access to the Judgment Day module, which is a comprehensive step-by-step guide to calculating the intrinsic value and buy price of a stock. For the next 14 days only, you can enroll in Learn by Example for 30% off by using the coupon code JULY at checkout, and all of the information about the reports, the presentations, the Judgment Day module, and how to sign up at 30% off are all linked down in the description below. And as always, there are very limited spots available. As of the time of recording this, I believe there are about 60 spots left until Learn by Example will be closed. There is a limited number of spots, a limited number of people that I can take at one time, and that will be closed when those spots are reached until there are some open spots maybe a little bit later in the year. So for the first part of this portfolio update video, I want to go through each individual business in my portfolio and explain when I invested in this company, whether I added more in the last 12 months, what percentage it makes up in my portfolio, and then what return it generated over the past 12 months in the latest financial year. So let's start with the smallest position in my portfolio, and that is National Australia Bank with the ticker symbol NAB. National Australia Bank, of course, is an Australian company, and it was one of my very first investments that I made back in 2017. And I made one investment into the company, or maybe 2 small investments or something like that, and I haven't touched it since. And I don't plan on adding to this in the future. Really, the only reason why I hold it in my portfolio is just for sentimental value, just because it was one of my very first investments, and I kind of want to see how it goes, even though it's going to be progressively a smaller and smaller percentage of my portfolio. National Australia Bank makes up 0.9% of my portfolio at the moment. So as I said, a very, very small piece. And in terms of its returns, I am very grateful that it is a small piece of my portfolio because it has performed terribly over the past year and also since I first invested in it. So if we take a look at the returns and we break down the returns in terms of capital gains, dividends, and currency gains, first of all, there's no currency gains because it's an Australian company that I purchased in Australian dollars, so there's no sort of conversion there. In terms of capital gains, it has, over the past 12 months, a return of negative 30.8, so very, very bad. And in terms of their dividends, they have returned me 5.9% over the past 12 months, and those dividends are being reinvested. So that's just an investment that I'm just going to leave, and it's done terribly ever since I invested in it. However, I'm just going to hold on to it, and it is a large Australian bank, so there is a possibility that it does, moderately well over the very long term. So let's leave that one there, and let's move on to the second stock. The second smallest position in my portfolio is Joyy, and Joyy used to be called YY, and the ticker symbol is still YY. And this, again, was an investment I made in 2017, and this was a purely speculative investment. And I don't plan on adding to this since. I haven't even looked at this investment since. I don't even read the annual reports for it, really. I did for about a year after I held it, and then I just sort of stopped looking at it at all. And really, on that basis, I should probably just let go of this investment, get some cash out of it, even if it is at a loss, and move that money into an investment that I am confident can return me money in the future. But for some reason, it just hasn't been something that I've done. And I mean, the main reason probably is just that it's such a small part, again, of my portfolio. So it really doesn't have much impact on my overall portfolio performance. At the current time, YY makes up 1.8% of my portfolio. So a little bit bigger than the National Australia Bank position, but still a very, very tiny position in my portfolio, especially considering that the way I invest is that I'm looking for a small number of companies to invest 10% of my money into, 15%, maybe even 20% of my money into an individual business. So to have a business in my portfolio that's 2% is very, very small. In terms of the returns, so the capital gains for the past year have been 28%. It doesn't pay a dividend, and then the currency gains have been 2.2%. So this is a business that I purchased in US dollars on the US stock market. So as a result, there is some sort of currency fluctuations between the Australian and the US dollar. And overall, the return has been 30.2% for this investment over the past 12 months. So moving into the third smallest company in my portfolio, we are now moving into the businesses that I have thoroughly analyzed using the strategy that I use right now. And I'm very confident that these businesses will deliver me above average returns over the long term. And this first business is Facebook Incorporated with the ticker symbol FB. The first time that I invested into Facebook was during the Cambridge Analytica scandal that was going on in 2018. And if you're not aware, during that time, Facebook stock price dropped 20% in one single day. And then for the remainder of the year, it continued to drop and it ended the year down about 40%. So during that process, I made my initial investment into Facebook, and I also added to the position in April of this year. So I didn't add to it when stock prices were really, really depressed during March. I kind of wish I had in hindsight, of course, but I did invest into this company in April. At the moment, Facebook makes up 6% of my portfolio. So this is still relatively a small position compared to the other businesses that I've thoroughly analyzed and are in my portfolio, as you will see. And really, probably the main reason for that is just that its price has been okay for me to make an investment into it, but it has never sort of reached a price where I felt that I would be confident putting 20% of my money into it or 15% of my portfolio into this business. It just hasn't been cheap enough, and maybe it will at some point in the future. I don't expect that it will get back down to its lows that it's seen over the past couple of years, which has been, I think, maybe about $135 per share. I don't think it will ever get back there, but relative to its earnings, it may get cheap enough again that I will make a substantial investment. And I really like the company, so I hope at some point that happens so that I can add this and make it a bigger position in my portfolio. But in terms of the returns, we have capital gains for this business over the past 12 months has been 16.2%. It doesn't pay a dividend, and currency gains have been negative 3%. So that's for a total return of 13.2% over the past 12 months. The next business in my portfolio is Texas Roadhouse with the ticker symbol TXRH. And this is a business that's relatively new to the portfolio compared to some of the other investments. So I initially invested into this company in mid-2019, so about 12 months ago now. And that was a relatively small investment. I was just dipping my toes into it. I'd only sort of just started learning about that business specifically. So whenever I'm sort of new to learning about a company, I might put a little bit in if my initial research says that it's a good investment, but then I will not go all in or put a significant amount of money into that business until I've done further research. And that opportunity basically arose itself in March of this year. So stock prices, particularly for sectors that got hit really hard, like the restaurant industry in the US, stock prices went down significantly, and I made quite a significant investment into Texas Roadhouse during that time. And at the moment, this business is 8.9% of my overall portfolio. So again, in a similar position to Facebook, I would like to build this into a bigger position in the future if its price allows me to do so. During March, it got really cheap, down to about $25 per share. It shot all the way up to about 60, and now it sits at about 53. So I'll be waiting for it to go back down again in order to add more. And if that doesn't happen, then it will just sort of stay around that sort of 9-10% size in my portfolio. In terms of returns, so the capital gains for Texas Roadhouse over the past 12 months have been 36.3%. They do pay a dividend. It's been 0.6%, and currency gains have been negative 6.9%. So you can see that investments that I made prior to 2019, their currency gains are positive, whereas any investments that I've made after that have seen sort of negative currency impacts. But the overall return for Texas Roadhouse is a flat 30% over the past 12 months. So this one has done very, very well for my portfolio, although it is a relatively small piece, so it only contributed a little bit to my overall return. The next position in my portfolio is an index fund. So this is the Vanguard Australian Shares Index, and this basically tracks the top 300 companies in Australia. And I've invested into this index fund at various times over the past in 2017, 18, 19, and in 2020 as well. So just sort of various times over that period. Previously, it was a larger sort of percentage of my portfolio, and that has sort of gone down over time as I've grown in my confidence to analyze businesses, and as I've found more individual businesses that I want to put significant amounts of my portfolio into. So I would expect that this will continue to be a smaller piece of my portfolio over time, although I probably will continue to contribute to it at least once a year going forward. Currently, the Vanguard Index Fund makes up 12.1% of my portfolio, so it's quite a significant piece, although it has been going down over time. And in terms of returns, this is basically the top 300 companies in Australia, have returned capital gains of negative 3.7% over the past 12 months. Dividends have been 2.3%, and I get those dividends reinvested for this index fund. And then currency gains, of course, there's nothing. It's an Australian index, and that gives us an overall return of negative 1.3%. So this is one of my larger positions that performed quite poorly. And of course, it is the Australian market. It is that index. So we will be comparing my portfolio returns to the performance of this index later in the video. So there are two businesses left in my portfolio, and both of these businesses make up significant proportions of the overall portfolio. As you will see, the last one, of course, is very, very large, and I'm sure that many of you know what that position is already. But before we get to that position, this one, the second largest, is Corporate Travel Management with the ticker symbol CTD. Now, this is the newest business that I've added to my portfolio, and I initially invested into this business in February of this year, and then I added significantly more in March of this year, and I think maybe I made 3 or 4 different investments during that period into this business. But this was a business that I certainly didn't expect to be my second largest in my portfolio. When I initially invested in this company, it was sort of, it was a large position, but it wasn't that big. However, since it has performed so well, it's actually grown to be quite a large part of my portfolio. So corporate travel management currently makes up 12.9% of my portfolio, and that's actually down a little bit to what it was as a percentage just a couple of weeks ago. The stock was trading at about $4 at its lows in March, and it went all the way up to about $16 per share. Now it's down at around $10 per share, I believe. I'm not sure what it is at the time when this video is being released, but when it was up at around $16 per share, it was a significant part of my portfolio, maybe 15 to 20% in that range. In terms of performance at the current time, so performance over the past 12 months have been 34.9% in terms of capital gains. Dividends have been 0.2%. Currency gains were 0%, and therefore we have a total return of 35.2% for my second largest position in my portfolio. So that brings us, of course, to the biggest position in my portfolio, which is Thor Industries. And I've had this position for a very long time. I've spoken about it on the channel many, many times. And I think I've added to this position maybe 6 different times over the past couple of years. But most recently, in March of 2020, March of this year, I increased the number of shares that I had by 150%. So I'm still very much increasing my position in this business as it has gotten cheaper over the past year and 2 years really, now that it's sort of been going down for. And this position as a percentage of my portfolio is currently 32%. So this position is much bigger than any of the other positions, and as a result, its performance, its returns are having a dramatic impact on my overall portfolio returns. So in terms of this business specifically, in terms of capital gains over the past 12 months, the capital gain has been 109.4%. The dividends have been 2.2%. Currency gains have been negative 6.4%. And that gives us an overall return for this business over the past 12 months of 105.2%. So it's the biggest position in my portfolio, and it has been the best performer in my portfolio by a landslide. So those are all of the individual businesses that are in my portfolio, and that means that now we can calculate what the overall return of my portfolio has been in terms of capital gains, dividends, currency gains, and then of course the total of those 3. So in terms of currency gains, over the past 12 months, my portfolio has returned 45%, dividends have been 1.5%, currency has been negative 3.1%, and then overall, the return has been 43.4% for the stocks that are in my portfolio. And we can draw some comparisons to the major index in the US, the S&P 500, and the major index in Australia, the ASX 300, in order to see where this sort of fits in with the market average. Because it's not enough just to look at a really high return. You need to be comparing it to what the average was, because maybe the average over the past 12 months was 50%, and that would mean that I actually underperformed the market. But in terms of the S&P 500, capital gains have been 4%, dividends have been 2%, currency gains would have been 2% if I bought the S&P 500 index in the US in US dollars, and therefore the overall return would have been 8% over the past 12 months. And in terms of the ASX 300, the Australian market, capital gains over the past 12 months have been negative 11.4%. Dividends have been 5.2%. Currency, of course, is 0. And therefore, the overall return is negative 6.2%. So we have 8% for the US market and negative 6.2% for the Australian market, compared to my 43 and a bit % over the past 12 months. And I can already see what someone is about to comment below, and it is that, well, this is misleading because those are returns from the point July 1st, 2019 until now, whereas my portfolio, I have been contributing to it when the market has crashed. And I want to say that thinking that you can predict when to buy an index, that you would have bought more of an index during March, and therefore your index return would have been higher and closer to my return, that's a complete fallacy. And it's called a hindsight fallacy, because it's easy to look back and say that you would have bought at that dip at that point, but how do you know when you're investing in an index? The reason why I knew when I'm investing in individual businesses is because I've calculated their value, and I'm not buying them because I think that they're going to go up in the short term from that point and that they're no longer going to go down. I'm buying them because they're at a good price that offers me a strong long-term return. And I do not think that you can do the same calculation with an index fund. If you can, let me know how down in the comment section below, but I don't think that you can calculate the future earnings over the next 10 years for the overall US market and then figure out how to buy when it's crashing and sell when it's high. I don't think you can do that, so I'm just taking the index as you would have bought it if you just bought it a year ago and saw the returns up until now, comparing to my portfolio of individual businesses where I'm calculating their value and figuring out what is an appropriate price to pay, when to sit in cash, and when to invest heavy into businesses that are cheap. Now, there is one more thing that we need to talk about, and that is cash, because my portfolio is not 100% invested in those businesses. If you were adding up those percentages, you would have been missing about 25%. And the reason why is because 25% of my portfolio is in cash, which has generated a 0% return over the past 12 months. So we need to take that into account if we're being realistic about what my overall portfolio performance was. So taking into account that my portfolio was 75% invested and 25% in cash brings my return, including cash, down to about 32.1%. So that's probably the number that I should be focusing on, and it is the number that I do focus on. Obviously, the 43% is really nice, but that 43% means nothing if I was 90% in cash, because that means that my overall return was pretty much nothing. But I was mostly invested. I have been mostly invested, at least now. Prior to the crash, I was about 60% in cash. After the crash, I was about 30% in cash, and then that sort of fluctuated because I added more cash to the portfolio, and then also because the stocks in the portfolio got bigger, and as a result, the cash position got smaller. But even though I do have relatively less cash than I have in my portfolio in the past, my portfolio performance was still very, very good. And I'm certainly very happy with making 30+% while also having 25%, 1/4 of my portfolio in cash on the sideline. So as I mentioned at the start of the video, I do briefly want to talk about why I was able to so vastly outperform the market and why it was no accident. And I alluded to it a little bit before, and it was basically because I was sitting in 60% cash. I was mostly in cash prior to that crash. And then after the crash, I invested a significant amount of money. I went from 60% cash to 30% cash. And why did I do that? Was it just because I was buying because everything was going down? Was I buying because there was lots of red days? No, it's because I had valued those businesses. And prior to March and April, where the markets crashed, the businesses I wanted to invest into were not cheap enough to put more money into them. So as a result, my cash was building up. But after the crash, they were cheap enough. So I was investing. So I was using a strategy where I have a small number of businesses that I deeply understand. I had valued them, so I have an idea of what I can expect to get back from them in the future. And therefore, I knew I had a price level where I felt confident that if I invested at this price, I would make at least a 15% return over the long term, over the next 10 years. And my portfolio may very well go down for the remainder of the year, particularly if this event that sort of happened in March and April blows up again and everyone goes back into lockdown and businesses start to suffer again. It's likely that my portfolio will take another hit. But if that happens, I will happily invest more of my cash. I'm very happy and very keen to put more money into the market. Prices have gone very expensive again, so I won't be doing that unless there's another crash. And if there is a crash, I will be deploying more of that money into businesses that I think can deliver me strong long-term returns. And if you are someone who has been analyzing businesses and you understand the basics of what I'm talking about on this channel, however, you're ready to dive deeper into the analysis process to gain more confidence and consistency in your stock investment picks, then as I mentioned at the start of the video, there is a promotion on at the moment for July enrollment into Learn by Example. All of the information is linked down in the description below. Go check it out if you're interested. You can get 30% off for the next 14 days only, and it'll either be 14 days or whether the spots fill up, whichever one comes first. At the time of recording this, I think there's about 60 spots left. So once those spots fill up, it will be closed until further spots open up. So make sure you go check it out if that's something you're interested in. Check out the information. And if you need to reach out to me, you can. Again, everything will be linked down in the description below if you want to reach out and ask a question before you sign up. But other than that, how has the performance of your portfolio been over the past year? I'd love to hear your thoughts down in the comment section below, and any other thoughts that you have on my portfolio or anything like that. Any questions that you have about Learn by Example, I'll be able to answer them too. But leave a like if you enjoyed. But for now, I'll see you guys in the next video.